Which is the best dividend stock to buy, Home Depot or Walmart? Each of these companies reported earnings this morning. I've gone through the results and I've incorporated them into my analysis, although the data on screen may not reflect the updated information as the software has not incorporated the data just yet. However, I am going to include the new data in my analysis when I make this recommendation. So I'm going to analyze these two stocks on four different metrics, starting with the dividend yield. So let's get right into it. Now, Home Depot boasts a dividend yield of 2.54%. Meanwhile, Walmart boasts a dividend yield of 1.52%. Over the last decade, Home Depot has done a better job of growing its dividend per share, and investors of Home Depot from 10 years ago are now getting a dividend per share nearly 6 times what they were getting nearly a decade ago. Walmart too has increased its dividend per share, but not as meaningfully as Home Depot has. The next metric I wanted to look at is the dividend per share for the trailing 12 months and the earnings per share for the trailing 12 months, because companies pay dividends out of earnings. If they pay a dividend that's above their earnings, that's not sustainable. That's like a household spending more money than they earn. You can do that temporarily, right? You can dip into your savings, you can use your credit card, but you can't keep that up long term. You're eventually going to need to either cut spending or increase your income, because you're going to run out of savings and you're going to run out of your credit card limits. So that's the same with businesses. They can't pay dividends that are too high above their earnings per share. That's not sustainable. Starting with, so let's look at Home Depot. You look at very nice earnings per share growth over the last, let's say, 10 years, going back before 2014. Earnings per share have increased from less than $5 to over $16.59. Meanwhile, dividend per share have also increased very nicely, coming in at $7.35 in the trailing 12 months. So its dividend consists less than 50% of its earnings per share, so it's sustainable, and there is room for Home Depot to continue growing its dividend per share even if its earnings per share stays relatively flat or increases only moderately or even experiences a brief decrease. Home Depot can continue raising its dividends because there's a nice gap there between earnings and dividends. Walmart, meanwhile, its earnings per share for the trailing 12 months is experiencing an opposite trend compared to Home Depot. You see, its earnings per share is down from where it was a decade ago to $3.24 in the recent trailing 12 months, while its dividend per share has increased from close to $1.50 per share up to $2.23 per share. So over, let's say, 66% of its earnings per share are being paid out in dividends. So less room for Walmart to grow its dividend. Also, more concerning is that its earnings per share is on a downward trajectory. So if you're looking for dividend growth over the longer term, Home Depot looks to be your better option for now. Next, I wanted to look at revenue growth and compare the two's long-term revenue growth. And Home Depot has done an excellent job growing its revenue, keeping it above 0%, keeping it positive for the most part of the last decade, and experiencing an absolute surge during the pandemic where revenue growth increased over 30% for a couple of quarters actually. That has moderated. That increased by just 0.3% in its most recent quarter. Remember, I said I'm going to incorporate updated data that's not included in the charts because the charts are slower to respond to the quarterly results. I've already looked into them. And Home Depot is forecasting in 2023 that revenue is going to be flat. So no more revenue growth in 2023. And that was to be expected after the surge during the pandemic. Meanwhile, Walmart is still growing revenue 8.74% in the most recent quarter. Here in the data, in its most recent quarter updated, it grew revenue around 7%. Walmart is forecasting revenue growth in its fiscal year of between 2.5% and 3% for the results in calendar year 2023. For Walmart, it's fiscal year 2024. And I don't like it either that they label their fiscal years differently than the actual calendar year. It is what it is. But so for the upcoming year, Walmart's going to experience better growth than Home Depot is. Finally, I wanted to compare these two stocks in terms of valuation, and I'm using the forward price to earnings ratio. Home Depot trading at a forward PE of 17.82, while Walmart is trading at a forward PE of 22.66. Now, if I wanted to pick just one of these two excellent dividend stocks to buy right now, I would go with Home Depot. Yes, it's going to experience some near-term headwinds as revenue growth remains flat as consumers shift their spending away from home improvement. However, over the last decade and longer, Home Depot has done an excellent job growing revenue, growing earnings per share. I expect that to stabilize over the next decade, even though in the next year or year and a half or maybe even 2 years, that it might experience some fluctuations as the consumer behavior changes, right? But longer term, Home Depot is the best home improvement company, and people need to fix their homes, right? Homes experience wear and tear. You need to fix it. Home Depot's the leader. Second place is not as good as Home Depot is. So I'd go with Home Depot here if I had to pick one of these two stocks to buy. All right, that's all I've got for this video. I truly appreciate your viewership. I know there's a lot you could be doing with your time. I'm always grateful that you choose to be here with me, and I hope you'll join me again next time for another video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.